KRE is at 3 years low. Bank of America has been whisper of its 52-week low, not trading well. And Dan mentions it all the time. I mean, the banks are so vitally important. It's interesting when people dismiss what's been going on over the last month or so, with the same people that would tell you the importance of banks when things were going really well. The banks are the lifeblood of this country, and regional and small banks are the lifeblood of small and mid-sized businesses, which, again, are the lifeblood of this economy. So things are clearly not working out that well. The fact that gold is rallying here should disturb a lot of people. And the fact that the bond market, once again, is showing the volatility that it's had recently is also disturbing. But you started the show by, is there more to come into banks? Absolutely, because it's not just banks now. It's insurers, pensions fund, mutual funds, all those things are on the table.
And today is a disaster for whatever credibility you thought JP Morgan, the largest, best capitalized, best CEO, for what he said yesterday about this stage of the banking crisis. When you look at how it actually spread to money centers, at one point today, I looked down at my screens and I saw Wells Fargo, Citibank, and Bank of America all down about 4%. Think about that on the back of what's going on in regionals. So if right now, if investors don't have confidence in what Jamie Dimon has to say and what JP Morgan are doing to stem this banking crisis that sounds contained, this smacks of what we heard in the spring of 08. I'm just telling you that. And it doesn't have to be that these banks are in a difficult situation. These are the major monies. It's the perception of what investors think about it. And when you think about just the poor performance that we've seen in other parts of the kind of financially oriented, parts of the market, it's just not good. The areas that Guy just said. And then we can kind of extrapolate it a little bit. We've been talking about Blackstone a little bit. We've been talking about this BREIT. We've been talking about the gates that they have up and the demands that they have for the capital back. This is 6 months in a row now that they've actually been over, right. So to me, I just don't know how any banker can go out and say that this is contained right now, because it's clearly.
I mean, a down 4% move in Wells Fargo, moves like that aren't a big deal. But when you see a PacWest and you see a Western Alliance, you're trading down 20+%. You're trading as if they're the next failures. They're the next shoes to drop. And that certainly doesn't feel like the banking crisis is over. And whether or not it's true, perception is everything in this kind of market, especially as the exit, have the debt ceiling stuff going on. You got the Fed raising rates, Rebecca.
Right.
Much.
And the Fed today probably had an early look at the latest SLOOS survey, which is not a Dr. Seuss term. It's a senior bank officer survey to look at credit conditions in lending. We also got the European Central Bank version of that out for the first quarter today. I'm guessing we're getting the same message from both, which is credit conditions tightening, lending slowing. So the fact that we're getting higher rates, another hike likely tomorrow, plus that pulling back the de-risking within the banks, to your point, this is trickling through the economy, and the small and medium-sized businesses are going to get hit harder.
Yeah, and we haven't even felt it really yet. I mean, this is just through, the end of March,
right.
The data?
Yep.
It doesn't take into account what's going on in April.
Exactly.
And for sure it's going to be tighter.
That is mostly true, although we have seen housing slow. That's been months in the making, right? As the Fed was hiking rates, we saw that mortgages became just too expensive for people to buy new homes. So that has started. But you're right, we haven't seen yet the full effect. And, you can argue, well, the Fed should wait because, let's see, what's the harm? I don't think that's going to happen. I think, they'll probably hike, and I don't know what the language will be. Maybe it'll be, we're open to being ready to pause. I don't know that it'll be more than that. But I don't know. Today seemed really interesting. It's like they sort of rang the bell. Your point about perception, particularly for a bank, more than any other company, right? We always talk about if Bed Bath & Beyond, if their debt's trading really terribly, the customer doesn't know. They're still going to go buy their towels as long as a Bed Bath & Beyond exists. Yeah. It won't exist shortly. But so a bank is obviously a very different animal. I think we're going to see this bifurcation of money center banks and regionals just continue. And I think I still think that deal for JP Morgan was a fantastic deal. But it did really seem like they just sort of rang the bell today. But I don't understand why yields. I don't understand. Is it a slowdown that was weighing on yields? I don't know. I'm not really sure.
Why yields were lower.
Right.
Yeah.
Is it the perception that they're going to turn and cut?
I think it's the debt ceiling. I mean,
debt ceiling, just moving in from short term to longer term to avoid that T-bill issue.
Right. It might be partly that. I think, the gold move higher today, even Bitcoin, if one wants to consider that a safe haven of sorts for certain people. But the move into alternative assets and into safer places to be, defensive's the same, right? You saw Staples do well today, relatively speaking, I believe. So I think there is a story there in terms of where the capital is going. And long-term treasuries, I hear you on the Fed's not done raising rates. But if you get a decent yield, you're getting nervous about how much equity exposure you have. Maybe you have some cash, getting that 5% duration-free, risk-free, and then you have some longer dated.